All right. Hello, everyone, and welcome to this quick little introduction exam clip to the TiSEM Premaster FINA Finance course. Now, I've made this clip not only to introduce both myself and the Athena course to you guys, but also to give you a quick little taste of what you can expect from the exams this semester, with one exam level question that we will be covering in this clip. But before we get to all of that, first of all, I'd like to quickly introduce myself to you guys. So once again, hello, my name's Arjan, and just like you, I'm also a student. I've joined Athena roughly around this time last year, so I have a year of experience. And in this time, I have done up about 100 plus hours of teaching experience, teaching various courses from financial accounting to finance to all of that. And outside of that, I'm also a cum laude student with experience in finance as well. And outside of all the academics related stuff, I'm also a very big fan of sports. So that's just a fun little fact about me. And then with that out of the way, I'd like to show you guys the exam level question that we are going to be working with in this exam clip. So here it is. Now, I will already spoil for you guys that this is a question that will be around discounting and compounding. Now, if you feel confident and already want to try this exam level question yourself, feel free to pause the video right here and give it a whirl to see how far you get. And in the meantime, I'm going to move on to explaining, first of all, the concept behind this, the theory, and then how to get through this question specifically. So I hope you've given it a try, and then let's get started. Now, an important thing to know around finance is that finance is a fair bit of the time, it's about traveling through time. So moving values that we have now of certain things to the future and vice versa. Now, this isn't just as simple as saying that money moves through time and keeps the exact same value, because the value of money will always change a bit from present to future. Now, the reason for this is related to what you can do with money when time passes. Because when you have money free, you can always store that money on a savings account, and that will give you a specific amount of interest every year. Hence, when we have money today that we place on a bank account, we can actually earn money from that in a risk-free fashion. And this means that any time in finance that we are comparing the future value of something to the present value, we need to keep in mind that that money, if we had just kept it on the bank, would have gone up in value by what we call the risk-free interest rate, which is simply just the interest rate that you receive risk-free on money that you currently have on a bank account. Now, to further illustrate this, I have a quick little example right here. Here we have Nico, who owns $100 today, and his bank gives him 7% interest, risk-free interest, each year on his savings account. How much money will Nico then own in a year? Now, the way to go about this is, of course, Nico keeps his money on the bank account for 1 year, and he gains 7% per year. So that means that his money will increase by 7% over the period he has it on this account. And the way to calculate that is by simply taking the amount of money that Nico owns today, $100, and multiplying it by 107%. In this case, we write that down in decimals, so that is 1.07. And when we fill it in, we see that the amount of money that Nico will have in 1 year will be $107. Now, what's great about this little example is that it shows both present value and future value, which are the cornerstones that this exam will be built on. Now, present value and future value, of course, kind of explain themselves, but I will still show it here. The present value of a certain amount is just the value of something in terms of money today. So in the example, it was just the value of money. But later on, we will also be working with stocks and bonds and sometimes even projects that companies undertake. And we represent all of those things in money when using the present value. Now, the future value is then, of course, the value of this something in terms of money in the future. Now, this can be 1 year in the future, it can be 10 years in the future, or it can also be 1 month or 1 quarter in the future. It really depends on what the exercise is about. But remember always that no matter what the time period is, we can transform the present value into the future value risk-free, because you always have that risk-free rate from those bank accounts. Now, the way to do that, of course, you've already seen it in our little example right here, is to get our future value, we take our present value times 1 plus the risk-free interest rate that the banks offer, and that gets us our future value. In this case, an example, that's of course 1 plus 0.07, which gives us the 1.07 that we use in the example. And we can also always turn the future value into the present value. But for that, we use the discount factor / rate. Now, this we will go into detail about on the next slide as well. But what's important to remember is that the discount factor is nothing more than 1 divided by 1 plus the risk-free interest rate in parentheses. So it's just what we did with the future value, but now we divide 1 by this number. And that will just get us a number smaller than 1, which means that the money will decrease. And that's how you can see that's moving back in time. And I hope that slide's all a bit clear, because then we'll move on to kind of the fundament that this entire part of finance is built upon. And that is, of course, the time value of money and the rules that are related to it. Because you see, in finance, we are pretty much always comparing. We are making decisions about what provides the most value to us. And in that pursuit, we of course want to know sometimes how values from different periods of time own up. For instance, is it better to have $100 now or $120 in the future? But the thing with this is that in finance, the most important rule number 1 is that we can only ever compare values that are at the same point in time. Because comparing $100 now and $120 in the future is like comparing apples and oranges. There are so many things that could happen with that money, and the most important of those is the risk-free interest rate. For instance, if the risk-free interest rate is 30%, then $100 now will be worth $130 in the future, and that is worth more than $120 in the future. But if the risk-free interest rate is only 10%, then of course $120 in the future is better than $100 now. So we can only ever compare values at the same point in time. But of course, that's great to know, but how do we get these values at the same time periods? And that's where the gist of this little exam clip comes in. We do that via compounding and discounting. Now, compounding simply means to move a cash flow forward in time. And the way we do that is with the formula we saw on the last slide as well. Note that it looks a bit different now, but the key elements are still the same. To get our future value, we take our present value, which is here shown as C, and multiply it by 1 plus the interest rate in parentheses. And we then do that to the power of the amount of periods that have passed. Now, when we supply that in our example question right here, we have our present value of $100. We have our interest rate or risk-free interest rate of 7%. And we have 1 year, which will mean our amount of periods is 1. Note that if you need to use any other periods, it will most times be mentioned in the question. But if it's not mentioned, you can always assume that the interest rate you get is for a year, and the amount of periods will also be counted in years. So if we take n in years here, n will be 1, which means that technically you would be squaring this by 1. But of course, since that's not really relevant here, we don't write it down. But we will see in the example question that we will use that. Now that is what we call compounding, and that is how we move a cash flow from now into the future to get the future value. And of course, when we have money from now that we can move into the future, we also want a way to move values in the future to now. And we do that via discounting. Now, discounting is to move a cash flow backward in time. And it's pretty much the same exact thing as compounding, only now instead of multiplying our present value by our interest rate plus one squared by the amount of periods, now instead we divide our future value by 1 plus our interest rate in parentheses squared by the amount of periods. That is because money in the future, of course, is already been boosted by the risk-free interest rate. So to equally compare it to money we have now, we need to subtract that, which is why we divide it. Now also note, a good thing to know about these two formulas is since they are the exact opposite, if you input a value in the first formula, for instance 100, and you get an interest rate of 5% and periods of 1, and then you input that future value you get from that in the present value formula with the same interest rate and the same amount of periods, you will get the same answer back. So these are just two sides of the same coin. Now, that roughly covers all of the theory. But before we get started with our exam level question, I'd also quickly like to give you guys one of the most important and helpful tips that can be given in finance, namely, when you are working with values through time, to avoid making it messy for yourself, always draw a timeline to have an overview of what you are doing. Because this not only helps visualize what you need to discount and compound, but in harder questions, it can also help you understand why exactly, where exactly certain growth rates and things like that start. So be sure to always draw a quick timeline when you are working with these discounts. Now, to give a quick example of how helpful this can be, I have another example question. An enterprise will receive a cash flow of $10 million per year for the coming 3 years, starting 1 year from now. So 1 year from the present, we will get a cash flow. And after that, 1 year after that, we will get another one. And 1 year after that second cash flow, we will get a third one of $10 million. And additionally, important to recognize here, it's hidden at the end, but the risk-free rate that we will work with is 10%. Now with this, we have all the information we need to get the present value of all of these cash flows combined. But before we even start on that, first we make and overview our timeline. So what this question is asking here is what is the present value at time 0 of all of the cash flows combined? Now time 0 is right here. We call this a beginning part where the present value is located. We call that time 0. And this is then time 1, time 2, and time 3. Now in the first year, we don't receive anything. But after 1 year has passed, we receive our first cash flow of $10 million. Now what does that mean? That means that if we want to know the present value of this $10 million, we need to discount it by 1 year to get it back to the present value. Now, how do we do that? We do that with our discount formula right here. So the way we do that is we have our risk-free interest rate, we have our amount, 10 million, which is the future value, and we have our amount of periods, which is 1 year. So if we fill that in, I'm going to give you guys a couple of seconds for if you want to pause the video and try this yourself. After that, I will review the answers. All right. So what you do then is once you fill all of that in, see that my drawing is a bit in the way, you get this. 10 million divided by 1 plus 0.1, because 10% is of course 0.1, to the power of 1, which of course we stripe away. So since this is only 1 year that has passed, n is equal to 1, and with that we can fill our formula in. And with that we have done our first cash flow. And what's easy for this is in this question, the risk-free interest rate is constant. It does not change for year 1, 2, or 3. It stays the exact same. So what that means is that for the second cash flow, which happens 2 years from time zero, we can actually use pretty much the exact same formula while only changing the amount of periods. So once again, $10 million is the future value divided by 1.1 because the risk-free interest rate is still 10%. But now we square it by 2 because of the fact that now 2 years have passed. It's now 1, 2. So we need to discount it by 2 years to show that 2 years of interest has passed. Now, filling that in gets you your second cash flow, and then the third cash flow is old news at this point. You just replace the 2 periods with 3 periods because it's 1, 2, 3 years from now. And then you have the present value of all of your 3 cash flows. And when you count those up together, you should get $24.87 million. Now, what's instantly important to see about this is that this question here shows you why Rule 1 is so important. Because if you were to just say, oh, the value, all of these values can be compared, we get 3 cash flows of 10 million, so that's $13 million in total, you would have gotten a lot higher an amount of money back than you actually did, which could have led to you making the wrong decision and costing yourself or your company a lot of money. So that is why the rules are in place. Now, that brings us to the end of this theory part. I hope that makes it all a bit more clear. And then with that explanation sufficiently done, I think we are free to move on back to our exam level question. Now, once again, I will give you guys a couple of seconds for if you want to pause the video right here, if you want to try it yourself. So now knowing the formulas and knowing how compounding and discount works a bit more, you can try it again. And after that, I will show you guys how I would walk through this question. So I think that enough time has passed. We can immediately look, first of all, there are 2 important things, timeline, but also in story questions like this in finance, I always find it very handy to correctly mark the things that are important in a question. So let's do that first. Suppose that a young couple has just had their first baby and they wish to ensure that enough money will be available to pay for their child's college education. Currently, all of those costs together average around $12,500 per year. And on average, first of all, that's our first important part of information, so I've marked that purple. And most importantly, on average, tuition and other costs increase at a rate of 4% per year. Now, when you see a percentage and an increase, and they say it's per year, already instantly you should kind of start thinking about compounding. We have all the ready information to get started on compounding aside from the periods. Now, as we read the text further, if the child will go to college in exactly 18 years, how much should the couple have saved in exactly 18 years to pay for 4 years of college? Now, that is important because this last sentence, the second to last sentence, shows us the parameters of this question. Present time is not now, it's not 18 years in the past. We are looking at how much money they need to be saving in exactly 18 years, the present value at that time, to pay for 4 years of college. Which means in this case, our time zero is after these 18 years. And then the last sentence, once again, it's pretty much always kind of hidden at the end. The interest rate or the risk-free interest rate is 3%. Now, quick side note, sometimes they use the term risk-free interest rate, sometimes they just use the term interest rate, but those two you can always assume mean the same thing in questions like this. Unless it's explicitly stated otherwise, those two mean the same thing. Now, with the reading out of the way, let's first draw a timeline to help us understand exactly what we are looking at here. So I have this timeline right here, which shows us, first of all, we skip the first 18 years entirely for our present value calculation because they are not relevant aside from the growth rates of the tuition and the other costs. So what we have here is we have the present value. This is the time after 18 years. And on each of these little bars, 1 year of college needs to be paid. So year 1, year 2, year 3, year 4. Now, don't get confused by the fact that it starts at 0 and ends at 3, because we always just call the present time times 0 to make it easier for ourselves. Now, that's the first important step, because that shows us, first of all, we need to calculate 4 different cash flows, 4 different times that we need to pay money. Now, this question adds something a bit more than what we have been doing before, but it follows the same logic. Namely, they don't give you the cost of tuition at time 0. Instead, they give you it at times minus 18. So we need to calculate what the actual cost is for tuition at time 0. Now, we can very simply do that by using compounding. If we have $12,500 and the average costs increase by 4% per year, and 18 years have passed, that gives us all of the information to fill in our little compounding formula. Namely, C times 1 plus R in parentheses to the power of n. In this case, n is the 18 years that have passed right here. R is the 1 plus 0.04, which equals 1.04, of course. And C, that is, of course, our present value that we're going to turn into a future value, and that comes from here. So here you can see how all of the pieces we got from the text fit neatly and cleanly into our formula. Now, if we fill in all those gaps in our formula, we will get the following answer, which is $25,322.71. This is the cost of tuition at time 0. And if we look back to our timeline, we can see that we actually need to make one cash flow at time 0. So you can already actually instantly say that the first cash flow is simply just 12,000 times 1.04 squared by 18, which equals the number we just calculated. Now that is great, but then there's still one last main difficult part for this question before we can fully solve it, and that is we need the present value of the last 3 years as well, which means that we must first compound 12,500 to get them to the correct years, and then we must discount them with the interest rate to get our present value. Now, let's get started. First of all, what we need to do for the second year, I've already put it in the timeline as well. We need to do 12,500 times 1.04 squared by 19. Why by 19? Because now 19 years have passed from the time that the value of tuition was $12,500. So we just add 1 year from the previous year. And we will do that for time 2 and time 3 as well. That is the first step. The second step is we need to get the present value at time 0. So if we look at our timeline, we can see that we must discount this number by 1 year. Now do keep in mind, the value used to discount the interest rate is not the 4% that the college tuition increases by. We stripe that away. It is instead the interest rate that is given at the end of the question. So don't let them confuse you. Always keep in mind what percentage belongs to what. Now knowing that, we use our discount formula, which of course looks like this. We have our C divided by 1 plus the interest rate squared by the amount of periods. Now our C here is, of course, in parentheses, 12,500 times 1.04 squared by 19. And that we then divide by 1.03. And we don't have a 2 here because only 1 year has passed. So we squared by 1, which is of course the same. And when you fill it in, you have the present value of the second year, which is $25,568.56. Now, from this part on, it gets easy because now all we need to do is we need to look at our timeline and we need to see what changes. Now, we see once again, when we look at the third year, the present value of the third year, 1 more year has passed. So we do 12,500 times 1.04 squared by 20, because now 20 years have passed since the time that the costs were $12,500. And the same way that we increase this square by 1, we do the same for the present value. If we look at our little drawing down here, we see that for the second year, or the third year we are paying tuition, it's 2 years have passed since time 0. So we take 12,500 times 1.04 squared by 20 divided by 1.03 squared by 2, or just squared. And that gives us the present value of the third year, which is $25,816.80. And then for the last year, we do the same thing. We once again add one more to show that now 21 years have passed since that $12,500 cost. And we divide it by 1.03 to the power of 3, because if you count them, 3 years have passed since time 0. And that is how we can get the present value here. Now, of course, what they ask in the question is, what is the present value? How much should the couple have saved in exactly 18 years to pay for 4 years of college? So we need to add the present value of all of these 4 up. And when we do that, we get $102,775.50, rounded to 1 decimal. And with that, we have solved this pretty much exam level question. There's a decent chance that a question exactly like this one will pop up on your exam. So if you have been able to follow this along, and if you understand it properly now, or even if you were able to do it on your own, you're already well on your way to be prepared for the exam. Now, with that, we come to the end of this lesson. A quick few side notes about this chapter is about this question is, notice how they try to kind of confuse you by the way they format this story. In previous years, present value was always the time it is now, but in this question, the present value is 18 years in the future. Now, logistically, this is the same question exactly. We did the same thing as we would if the present time was 0, but there was this extra thinking step. And confusion like that is kind of what they try to do in the exam to throw you off your game. So that is why I give the tips both draw a timeline and mark the important information in the chat or in the text to help avoid those confusions, those roadblocks they throw at you. And with that, I hope this lesson has kind of been useful to you. And before we end it fully, I'd also quickly like to show you guys this little slide. Now, what is shown here is the difference between a free Athena course or a recording of, which is what we just did, and what you can expect to get in the full Athena Studies exam training for the Finance Premaster. Now, what we offer here is, of course, we show you topics and we give you practice questions to practice with them along with explanations. But with the full training, not only will you get these things, but for all of the relevant exam material that will be covered on both the midterm and end-term exam, depending on which of the crash courses you buy. But on top of that, the groups will be relatively small, which will give you room to ask any questions you want during the lessons. And I will explain them thoroughly, at least try to the best of my ability. And outside of these groups, outside of the lessons themselves, we also offer these select group chats where you will be able to get 24/7 WhatsApp aid, in which you can just send me a picture or a question or anything else, and I will answer you as soon as I get to them. So with that, I hope I have properly introduced myself, Athena, and what we plan to offer you this semester. And also I hope to have kind of shown you a quick taste of what you can expect on the exam. Now, depending on when you watch this, I assume it will be somewhere in the first week. So I want to wish you guys all the very much of luck with your first week. And I also hope that you get through the first week all nice in the first couple of weeks. And I hope to see you guys in one of my lessons one day. Right. Have a nice day.